Welcome to The Explainer. So today, we're exploring a market that is quite literally a living, breathing organism. You see, the foreign exchange market isn't just some static graph on your screen. It rests, it wakes up violently, and it sprints across a 24-hour cycle all around the globe. If you want to understand how price actually moves, and more importantly, why it moves exactly when it does, you absolutely have to deeply understand this continuous daily rhythm. To put things into perspective, let's just start with the sheer massive scale of this market. $7.5 trillion is traded daily. That is an unfathomable amount of capital. But here's the secret that so many traders completely miss. That money is not evenly distributed throughout the day. It actually creates aggressive, sweeping waves of capital that can instantly wipe out a trader who just happens to be caught at the wrong time. So while that staggering $7.5 trillion changes hands every single day, the timing of your trade is literally just as crucial as your strategy. You can have the exact right idea, but if you execute it at the wrong time, you can still lose everything. Okay, let's dive into this. The real question we need to answer is, when is the smart money? We're talking the major banks, the institutions, and those massive algorithmic trading systems actually stepping into the market. While institutional algorithms are essentially hunting for liquidity all day long. Simply put, massive institutions can't just click buy on a $100 million order without wildly spiking the price against themselves. They have to find specific pockets in the market where thousands of retail traders have predictably placed their stop-loss orders. If you don't know exactly when these giant algorithms are awake and hunting, you might just unknowingly become the exact liquidity they need to fill their massive orders. Here's our roadmap for today. We're going to walk through the global liquidity cycle, then break down the unique personalities of the Asian, London, and New York sessions, explore the massive power of session overlaps, and wrap it all up with some real-world trading strategies. Starting off with Section 1, the global liquidity cycle. So the foreign exchange market is entirely decentralized, right? There's no central physical exchange building like Wall Street for stocks. Instead, it relies on this continuous global liquidity rotation. If we just follow the sun across the timeline, we can see this 24-hour relay race of capital in action. The trading week officially kicks off in the Asia-Pacific region with the Sydney Open, followed shortly by Tokyo. As the Earth turns, volume naturally passes over to Europe with the London Open, and finally across the Atlantic to the Americas when New York opens. It's a literal handoff. The liquidity completely relies on bank traders in Tokyo physically logging off their terminals, just as traders in Frankfurt and London are pouring their morning coffee and turning theirs on. Now, what's really interesting about this is the sheer imbalance in where this daily volume actually happens. The London session alone captures a massive 30 to 35% of total daily volume. New York pulls in another 20%. Together, the European and American hours absolutely dwarf the rest of the day's activity. Why? Well, because London sits perfectly in the geographic center of the financial world, right? It overlaps with late Asian business hours and the early U.S. morning, holding a huge concentration of banking syndicates. But listen, just because the quieter hours in Asia have less volume, that definitely doesn't mean they aren't important. In fact, they set the stage for the whole shebang. Which brings us to Section 2, the Asian session, where liquidity is accumulated. Operating mostly through the Tokyo and Sydney hours, this phase is essentially the market's resting state. Let's ground this abstract concept in some hard data. Because of the lower overall volume during these hours, major currency pairs might only move within really tight 20 to 50 pip ranges, representing a very compressed, almost flatlining market. European pairs barely move at all during this time. However, active regional pairs tied to the local economies, like the US dollar to the Japanese yen or the Aussie dollar to the US dollar, they see steady, predictable ranges with moderate spreads. This makes it a highly structured environment for very specific types of trading. And this low volatility, it isn't a weakness, it's absolutely an intentional feature. We call this the accumulation phase. It's not just random sideways chop, the price shows strictly defined highs and lows, bouncing back and forth. Think about it. How do institutions accumulate massive positions without moving the price? They buy a little bit, let the price drift up to resistance, then wait for it to drop back down to support and buy a little more. They are literally manufacturing that tight, predictable box to quietly hoard contracts and build deep liquidity pools right before the rest of the world wakes up. Moving on to Section 3, the London session, also known as the breakouts. Okay, when the European powerhouse session opens, the market violently wakes up. But this awakening almost always comes with a lethal trap, known as the Judas swing. This is a totally engineered false move created by market makers right at the open. Let's walk through the psychology here, because it's fascinating. Retail traders spot the price breaking out of that quiet Asian range and immediately rush to buy, terrified of missing the daily trend. At the exact same time, retail sellers who are trading the range have their stop losses sitting just outside that box. So when London opens, banking algorithms intentionally push the price in the wrong direction to hit both groups. They trigger the retail FOMO buys and hunt those stop loss sells. This flood of panicked retail orders provides the massive pool of liquidity the banks need so they can take their actual position, aggressively sending the price in the completely opposite direction. And this brilliantly illustrates the core dynamic. The Asian session builds the box and London breaks it. Imagine a trader watching the euro against the US dollar bounce aimlessly for 6 straight hours during the Tokyo session, doing absolutely nothing. Then, suddenly, boom. Within the first 45 minutes of the Frankfurt and London Open, it launches 80 pips in a massive trending move. That explosion is the direct result of the liquidity trap being sprung. If you understand this two-step process, you instantly gain a massive edge over traders who are just blindly reacting to green and red candles. Next up, Section 4. The New York session and its high volume. As we shift into the Americas, the US dollar takes absolute center stage. Remember, the US dollar is involved in roughly 88% of all Forex transactions globally. When New York wakes up, it dictates the ultimate distribution of the daily trend. A massive driver here is US economic data drops, specifically things like NFP, which is non-farm payrolls, and the CPI, or Consumer Price Index. These releases typically hit exactly at 8:30 a.m. Eastern Time and act as explosive catalysts. We're talking moves of 100 pips in mere minutes, setting the directional tone for the entire rest of the day. Plus, later in the afternoon, as London finishes its day and closes out, we regularly see profit-taking flows that cause sharp reversals away from the day's extreme highs or lows. All right, Section 5, the power of overlaps and peak liquidity windows. So the Forex market isn't just a series of isolated sessions operating in a vacuum. The absolute most explosive windows of the day happen when two major financial centers are operating simultaneously. And the undisputed king here, the London-New York overlap, often called the golden overlap. This happens between 1300 and 1700 GMT. Why is it golden? Because you have the colossal financial hubs of Europe and Wall Street crossing paths. You've got massive US corporate hedging, European profit-taking, and global institutional rebalancing all colliding at once. This frantic 4-hour window compresses a staggering $3 to $4 trillion in liquidity, representing 60 to 70% of all daily trading volume. Look at the dramatic shift in transaction costs between these periods. During the quiet Tokyo session, the spread, which is essentially the fee you pay to enter a trade, for the euro against the US dollar might hover around 1 pip. But during that frantic London-New York overlap, transaction costs plummet to an incredibly tight 0.1 to 0.3 pips. Now, why does that matter? Well, for a retail trader, it's just a few bucks. But for a massive banking institution, dropping from 1 pip to 0.1 pips means they can execute billions of dollars in orders completely effortlessly without moving the market price against themselves. That depth of liquidity is exactly why volatility reaches its absolute peak here. Finally, Section 6, Trading Insights and Strategies. Let's align with the cycle. So, how do we actually apply all of this macroeconomic data to make better decisions? One incredibly powerful framework derived from our sources is the AMD strategy. It maps flawlessly to the 24-hour cycle we just explored. It's a sequential chain reaction. First, accumulation builds the trap during the quiet Asian session. Second, manipulation springs that trap as the London session opens, sweeping liquidity to gather fuel. Third, distribution uses that newly acquired fuel to drive the real, sustained trend during the New York session. Recognizing which of these 3 exact phases the market is currently in pretty much dictates everything. It tells you whether you should be sitting on your hands, fading a false breakout, or confidently riding a massive trend. To execute a strategy like this, advanced traders focus heavily on what are called kill zones. These are incredibly specific, highly volatile time windows right at the session opens. In the real world, the London kill zone typically occurs between 2 a.m. and 5 a.m. Eastern Time. The New York kill zone follows between 7 a.m. and 10 a.m. Eastern. This is the exact window when institutional algorithms wake up and are the most active. If you want to catch genuine major trends and avoid the false sweeps, these narrow hours are when you absolutely must be at your desk watching the charts. Trying to trade massive setups outside of these windows, it often just means getting chopped up in meaningless algorithmic noise. Ultimately, this comes down to a fundamental battle of mindsets. So the crucial point is this: the retail trader operates almost entirely on the fear of missing out. They see a big green candle breaking out of a range and think, breakout confirmed, I have to buy right now. But the smart money, the institutional algorithm, operates strictly on logic and where the liquidity is resting. They look at that exact same chart and think, perfect, look at all those overeager buyers. Time to sweep below and sell our massive positions to them. Timing your trade to the correct phase of the session cycle is the only thing that prevents you from falling into that retail FOMO trap. The most practical takeaway from all of this data is that you absolutely must match your personal trading strategy to the specific time zone you're actually trading in. If you try to trade a massive explosive breakout strategy during the quiet Asian hours, you're going to face endless false signals and frustration. The market just doesn't have the volume for it then. If you prefer low-stress, predictable support and resistance, be a range trader during Sydney and Tokyo. If you want those explosive trending moves, trade the London Open. And if you rely on high liquidity and razor-tight spreads for quick scalps, focus your energy exclusively on the golden London-New York overlap. Let's leave it on this provocative thought for today. Take an honest look at your own approach. Are you actually trading the right strategy for your specific time zone, or are you unknowingly just becoming liquidity for the smart money simply because you're trading in the wrong session? The market isn't random. It moves in a deeply structured 24-hour cycle. Learn this rhythm, study the order flow, and use timing as your ultimate advantage. Thanks for joining me on this explainer. And